So let's get right into it. Over the last 5 years, Lupin Limited has pulled off a really remarkable structural transformation. It's being called the Phoenix Recovery for a reason. We're talking about a fundamental shift from being a traditional generics maker to a powerhouse in complex, high-barrier drugs.
And this slide, well, this is the result of all that work. In February 2026, the company hit its highest ever quarterly U.S. sales, a staggering $350 million. Now, this wasn't just a good quarter, it was an absolute blockbuster, driven by a massive 24% jump in revenue. It's really the peak of a years-long pivot, which brings up the big question: how on earth did they do it?
To really get the scale of this comeback, we've got to rewind a bit. Let's look at the anatomy of this turnaround, starting from the absolute bottom and tracking the strategic pivot that really changed the game.
Okay, let's go back to May 2022. This was the low point. The company was getting hammered by pricing pressure in the US. Its margins on generics were weak, stuck down in the low teens. Plus, it was way too dependent on in-licensed products. Basically paying other companies to market their drugs. And with no new approvals coming through, the US business was just stuck.
Then came the catalyst. The big moment was in August 2023, with the US FDA approval for gSpiriva. Look, this wasn't just another product getting the green light. This was the turning point. It signaled a deliberate move away from those simple, commoditized pills and toward a high-barrier respiratory franchise. We're talking about mastering really complex tech, like dry powder inhalers.
So, how does that one pivot create a whole new profit engine? Well, this was about more than just a single product. It was about building a durable, sustainable, competitive moat around the whole business.
Now, check out the margin story here. It's pretty incredible. The company totally realigned its cost structure. EBITDA margins literally exploded from those low teens we saw back in 2022 to a really impressive 31 to 33% range by early 2026. And this wasn't just a lucky break in the cycle, it was a deep, structural change, all driven by a new quality over volume strategy and focusing on high-value launches.
This really lays out the long-term vision. The plan is to get 62% of all revenue from these complex, high-barrier platforms by 2030. By moving into these technologies that are super difficult to replicate, Lupin has built a much stronger wall around its business, making it way harder for competitors to catch up.
And another huge piece of this new profit engine was, honestly, a bit of a lucky break. Their generic version of Genarc, called tolvaptan, was supposed to face competition after its 180-day exclusive window. But that competition never showed up. Lupin has stayed the sole generic player, and that sustained exclusivity has given their profitability and margins a massive, unexpected boost.
All right, so with that as the backdrop, let's build the bull case. What are the main arguments for why this growth could continue based on these recent wins?
First up, a huge risk is now off the table. For years, there was this regulatory cloud hanging over the company. But in late February 2026, they got a satisfactory inspection report for their Goa facility, finally clearing its VAI status. That de-risks a huge part of their supply chain and really paves the way for future product launches.
Second, you can't ignore how strong their domestic business is. By focusing on chronic treatments like cardiology and respiratory care, Lupin's India business is seeing double-digit growth. That's way ahead of the broader Indian pharmaceutical market. It's a strategy that strengthens their home turf and protects them from some of that pricing craziness.
And third, the company is now a financial powerhouse. With a net cash position of almost 2,900 crore rupees, Lupin isn't just a turnaround story anymore. It's officially shifted into a growth compounder. It's got the cash to go after strategic acquisitions and pour more fuel on its expansion. But of course, you have to look at the other side of the coin. So let's pivot and break down the bear case. What are the potential risks and headwinds that could actually challenge this growth story?
The number one risk really comes down to the sustainability of those incredible profits we were just talking about. A big chunk of that recent margin jump is tied to being the only generic for tolvaptan. And with new competitors expected to enter as early as late 2026, the risk of rapid price erosion is very, very real. Add to that the constant drug pricing pressure in the US and a crowded biosimilar market, and you've got some serious challenges ahead.
Which brings us to what's next. Lupin is now setting its sights on the next frontier, oncology and biosimilars. They've made a $700 million deal and have an ambitious pipeline aiming for over 200 launches by 2030. So this leaves us with the big, lingering question. Is this massive pipeline the company's next powerful growth engine,
Or is it a capital-intensive, high-stakes gamble in an incredibly competitive arena?